AMD just reported Q1 2026 earnings, and this was not a boring quarter. This was one of those reports where the market reaction actually makes sense, because AMD beat expectations, guided above expectations, and most importantly, showed that the investment story is becoming less about a PC recovery and more about whether AMD can become a serious AI infrastructure company. So in this video, I want to walk through what happened this quarter, why the data center segment is now the whole story, what the Meta partnership could mean, and whether AMD stock still makes sense at around $355.26 per share. And as always, if you enjoy stock breakdowns like this, hit the like button, leave a comment with your thoughts on AMD, and subscribe for more investing videos. Let's start with the headline numbers. AMD reported $10.3 billion of revenue in Q1, up 38% year-over-year. GAAP EPS came in at 84 cents, while non-GAAP EPS came in at $1.37. Those are strong numbers, but the real story is underneath the surface. Data center revenue was $5.8 billion, up 57% year-over-year. That means data center is now more than half of AMD's total revenue. And that changes how investors have to think about the company. For years, AMD was often viewed through the lens of CPUs, gaming GPUs, and PC cycles. Those still matter, but they are no longer the main reason investors are willing to pay a premium for the stock. The market is now looking at AMD and asking, can this company become one of the major AI infrastructure platforms over the next 5 years? That is a much bigger opportunity. It is also a much harder bar to clear. The quarter itself was strong across the board. Revenue was up 38% from last year, gross margin improved, operating income grew, earnings grew, and free cash flow was excellent. Operating cash flow was $2.955 billion, and free cash flow was $2.566 billion. That last number is especially important. In AI and semiconductors, it is easy to get excited about revenue growth, but I want to know whether that growth is actually turning into cash. In this quarter, AMD did that. Free cash flow margin was around 25%, which is a very clean sign that the business is not just growing on paper. The balance sheet also looks strong. AMD ended the quarter with $12.347 billion of cash and short-term investments, compared with $3.224 billion of total debt. So, financially, this is not a fragile company trying to fund its way through a risky growth phase. AMD has a real net cash position and plenty of flexibility. Now, the one part that makes the quarter a little less perfect is the sequential margin trend. Non-GAAP gross margin was 55%, up from 54% last year, but down from 57% in Q4. Non-GAAP operating margin was 25%, up from 24% last year, but down from 28% sequentially. So yes, AMD is scaling profitably. But no, we are not seeing explosive operating leverage every single quarter yet. And honestly, that makes sense. The company is spending aggressively to build out its AI opportunity. The question is whether that spending turns into durable revenue, stronger margins, and long-term free cash flow. That brings us to the segment breakdown. Data center was the standout. Again, $5.775 billion of revenue, up 57% year-over-year and 7% quarter-over-quarter. This is the engine now. It is the fastest growing segment, the biggest segment, and the main reason investors are excited. Client and gaming revenue was $3.605 billion, up 23% year-over-year, but down 9% sequentially. That is still a meaningful business, and it gives AMD diversification. But it is not the thing driving the premium multiple anymore. Embedded revenue was $873 million, up 6% year-over-year, but down 8% sequentially. Smaller, slower, but still strategically useful because of AMD's exposure to FPGAs, networking, industrial markets, and edge AI. When you step back, the mix shift is pretty clear. AMD is becoming a data center-led company, and this is where the Meta partnership becomes really important. AMD said Meta plans to deploy up to 6 gigawatts of AMD Instinct GPUs, with the first 1 gigawatt powered by a custom MI450-based GPU. Meta will also be a lead customer for 6th-generation EPYC CPUs, codenamed Venice and Verano. That is not just another customer announcement. In AI accelerators, hyperscaler validation matters a lot. NVIDIA's advantage is not just that it has powerful chips, it has the ecosystem, software deployment trust, developer familiarity, and scale. So when a company like Meta commits to large-scale AMD deployments, it gives AMD more credibility as a rack-scale AI infrastructure provider. Still, announcements are not the finish line. AMD has to ship the hardware, support customers, scale supply, improve software, and prove that these systems work reliably in real production environments. That is the hard part. AMD also highlighted cloud expansion across AWS, Google Cloud, Microsoft Azure, and Tencent for 5th-generation ePike-powered instances. This part of the story may be less flashy than AI GPUs, but it is very important. AMD's server CPU business is already more established than its AI accelerator business. ePike has real traction in cloud and enterprise workloads. And if AI infrastructure spending increases the need for CPUs as well as accelerators, AMD can benefit even when it does not win the GPU socket. The report also mentioned that AMD now expects the server CPU market to grow more than 35% annually to reach $120 billion by 2030. That is a major upward revision to the CPU opportunity, and it helps explain why data center is becoming the center of the thesis. Another important piece is memory supply. AMD is collaborating with Samsung on next-generation AI memory and compute technologies, including HBM4 supply for Instinct MI450X GPUs. This matters because AI chips are not just about designing a great accelerator. You also need advanced memory, packaging capacity, substrates, and supply chain execution demand can be huge, but if you cannot get enough HBM or package enough systems, the revenue cannot scale the way investors expect. On performance, AMD said Instinct MI355X delivered strong results across the MLPerf suite, including leadership results in multiple categories. That helps the credibility story. AMD cannot compete only by being cheaper. It has to show that its hardware can perform. The tricky part is that benchmarks do not automatically translate into adoption. Software maturity still matters. Developer experience matters. Customer support matters. And this is where NVIDIA's CUDA ecosystem remains a massive moat. That is probably AMD's biggest competitive weakness today. Rawkim has improved, but CUDA is still deeply entrenched. AMD can win where customers want a second source, customized deployments, better economics, or tight CPU and GPU integration. But broadly displacing NVIDIA is a very different challenge. And to be clear, AMD does not need to beat NVIDIA to be a good investment. It just needs to capture enough share of a very large AI infrastructure market. The bar is not become number one. The bar is become a credible number two at scale with good margins. Now let's talk guidance, because this is a big reason the stock reacted so positively. For Q2, AMD guided revenue to around $11.2 billion, plus or minus $300 million. That implies roughly 46% year-over-year growth and 9% sequential growth. Non-GAAP gross margin is expected to be around 56%. That guide was above expectations, and for a growth stock, the guide often matters more than the quarter that just ended. The market does not only care that Q1 was good, it cares that management sees momentum continuing into Q2. Lisa Su described the quarter as outstanding and pointed to accelerating demand for AI infrastructure. Management also said data center is now the primary driver of revenue and earnings growth. That tone is confident, not cautious, not vague. Confident. The risk is that confidence raises expectations. AMD now has to prove that MI450, MI455, Helios, ePikes, Rawkim, and the broader AI infrastructure roadmap can turn into sustained growth over multiple years. And that brings us to valuation. At around $355.26 per share, AMD's market cap was about $583 billion. After adjusting for cash and debt, enterprise value is roughly $574 billion. Using Q1 annualized revenue of about $41 billion, AMD is trading at roughly 14 times annualized revenue. That is a premium valuation, no way around it. On trailing GAAP earnings, the multiple looks extremely high, around 175 times earnings, partly because GAAP earnings are still affected by acquisition amortization and because the market is pricing in future growth. Forward PE estimates are more reasonable, somewhere around the mid-40s to mid-50s depending on the estimate set, but that is still not cheap. So the valuation debate is pretty simple. AMD looks expensive on today's numbers, but it is not irrational if the company can grow into a much larger AI and data center business. The market is basically assuming that AMD can keep growing data center, scale AI accelerators, gain server CPU share, expand margins, and generate a lot more free cash flow over time. Those things are possible. Q1 made them look more possible, but they are not guaranteed. This is where the 5-year outlook gets interesting. In the base case, AMD reaches around $85 billion of revenue by 2030, with a non-GAAP operating margin of around 32%. That leads to roughly $13.50 in EPS. If the market gives AMD a 28 times earnings multiple at that point, the stock would be worth around $380, compared with $355.26 today. That is only about 7% upside. And that is the main issue. The base case can involve AMD doing pretty well as a business, while the stock does not generate amazing returns because so much success is already priced in. In the bull case, the picture looks much better. AMD becomes the clear second large-scale AI infrastructure platform after NVIDIA. Meta and other hyperscalers deploy AMD systems at scale. ePyx keeps gaining share. AI accelerator revenue ramps faster than expected. RAW-CM becomes more accepted. Margins expand more strongly. In that scenario, AMD gets to around $115 billion of revenue by 2030, with a 37% non-GAAP operating margin and around $20.80 in EPS. Put a 35 times earnings multiple on that, and you get a projected share price of around $730. That would be about 105% upside from the current reference price. So yes, there is still a real bull case here. But the bear case is also uncomfortable. If AMD's AI accelerator ramp disappoints, if software adoption lags, if hyperscaler deployments are more limited than expected, and if client and gaming normalize lower, AMD could still be a good company while the stock performs badly. In the bear case, revenue reaches about $55 billion by 2030, operating margin is around 22%, EPS is around $6.10, and the market assigns a 20 times earnings multiple. That gives a projected share price of around $120. That would be roughly 66% downside, and I think this is the right way to frame AMD today. This is not a low-quality company. It is not a broken business. The risk is that the stock is priced for a level of AI success that may or may not fully happen. For me, the most important things to watch next quarter are data center growth, gross margin, operating expense growth, free cash flow conversion, and any updates on MI450 and Helios deployment timing. The Q2 revenue guide of $11.2 billion is strong, so investors will want to see whether AMD can beat that and show continued momentum. I would also watch whether non-GAAP gross margin really moves toward 56%. Margin expansion is critical. Revenue growth alone is not enough at this valuation. And finally, keep an eye on supply. HBM, packaging, substrates, manufacturing capacity, and yield can all become bottlenecks. In AI chips, demand is only one side of the equation. Execution across the full supply chain matters just as much. So where do I land? AMD had a strong Q1. The data center business is accelerating. Free cash flow was excellent. The balance sheet is healthy. The Meta partnership strengthens the AI infrastructure story. And the Q2 guide suggests momentum is continuing. The business thesis is improving. The stock thesis is more complicated. At around $355, AMD looks fairly valued to slightly overvalued unless you believe the bull case is increasingly likely. The upside is still attractive if AMD becomes the clear number 2 AI infrastructure platform. But in a more normal base case, the 5-year return does not look especially compelling from here. So my view would be neutral to moderately bullish with high risk and medium confidence. AMD is a high-quality company with a genuinely improving long-term story. I just would not call the stock obviously cheap. The business has to execute very well to justify the current valuation, and even small disappointments could matter because expectations are already high. That is the AMD setup right now. Better business momentum, stronger AI credibility, excellent data center growth, but a stock price that already reflects a lot of optimism. Let me know in the comments how you see it. Do you think AMD can become the true number 2 AI infrastructure platform, or is the valuation already too stretched? And if you found this breakdown useful, hit the like button, subscribe, and I'll see you in the next one.